Have you ever wondered what it actually takes to get an 850 credit score? Well, in this video, we're going to cover the 9 simple steps to a perfect credit score, and none of them are going to cost you a dime. If that sounds good to you, please consider crushing the like button for the algorithm, and here's step 1. Step 1 is free thanks to annualcreditreport.com being mandated by federal law. Now, once you're there, you're going to request copies of your credit reports from each of the 3 credit bureaus: Transunion, Experian, and Equifax. You'll then want to examine them for any evidence of things like the following: identity theft or fraud, your accounts getting mixed up with someone else's, for example, property that you don't own, or errors in public records, for example, a bankruptcy that was not actually yours. This process is called identifying inaccuracies, and making a specific list of them from each of the 3 reports is step 1. With that list in hand, you're now ready for step 2. For step 2, you're going to need the contact information for the credit reporting agencies shown here, and I'll put all this in the description with working links as well. But besides having the credit agency contact information, step 2 requires some background knowledge, specifically that the credit reporting agencies don't have direct knowledge of your payment history. Rather, the credit reporting agencies have this data transferred to them from other sources, namely from the banks that loaned you money, the utility companies in your name, the leasing companies you signed with, and so on. Sometimes mistakes happen during the transfer of data between these 2 groups, or data is sometimes reported as yours, but which isn't actually yours at all. And therefore, step number 2 is using the above contact information to correct any mistakes you found in your credit reports during step 1. The process of correcting mistakes is called a credit dispute, and it works like this. After receiving your dispute, the credit reporting agencies are then required by law to investigate with the reporting creditors. This could take up to a few weeks, but the goal is to get the incorrect information removed in one of several ways. Either the incorrect information is removed directly, or perhaps the creditor doesn't respond to the agency at all, which is also grounds for removal. With inaccuracies removed, you're ready for step 3. For step 3, we'll need to focus on all creditors. Credit card companies, mortgages, car loans or leases, everything counts. Our objective is to focus on building a history of paying every last creditor on time, even if you've missed a few payments in the past. A few tips here. First, set up automatic minimum payments for your credit cards, and second, automatic pull payments, not push, from your mortgage servicer into your bank account if you have a mortgage. This will prevent things like a $15 minimum missed payment on your credit card or a $15 increase in your mortgage payment from turning into credit score damage, and these things do happen. With a history of on-time payments now being built, step 3 is complete. For step 4, we need a little background information, and that is knowing how to calculate your credit utilization ratio. This is the ratio of your used credit to your available credit. As an example, if the total available credit across all of your credit cards is $10,000 and you have $3,000 in charges across all of those cards, your credit utilization ratio is 30%. Credit utilization ratio applies only to things like credit cards and not to things like mortgage payments, but more on that in step 7. Next is to know what credit utilization ratio we should be targeting. Our example of 30% is the highest maximum you'll want to allow in any scenario if possible. And step 4 itself is taking the time to get that ratio under 10%, which is the ideal maximum you'll want to target. But you may be thinking, easier said than done, Alex. And therefore, our next step 5 are proven strategies on how to lower our credit utilization ratio. To get our credit utilization ratio under that 10% mark, we need to choose a plan for paying off our debts strategically. And there are a few methods that can work well. One method is to pay off your highest interest rate debts first, such as credit cards or personal loans. This strategy is purely math-based and therefore has merit. A credible second strategy is the debt snowball approach, a favorite of Dave Ramsey. In this strategy, you don't necessarily focus on the highest interest rate debt first, nor necessarily the highest absolute value debt first, but rather the lowest absolute value debt first, and then you work your way up to the highest value loan. This strategy is human psychology based because you'll get creditors off your back quickly. And it's logic based because every creditor eliminated is one less person who can control you or damage your credit further. And this approach eliminates creditors quickly. Putting one of these or another strategy to work, and therefore being in the process of actively lowering your credit utilization ratio, is step 5. And we can now move on to step 6. Just the act of having your credit checked by a lending institution lowers your credit score. This is called a hard inquiry in the credit world, and the drop can be as much as 5 or 10 points per hard inquiry. Therefore, after step 5 is in place and we're reducing creditors, step 6 is avoiding new credit applications. But what if you have high interest credit cards, or your card has some nasty fees that aren't exactly helping you get out of debt, and therefore you want to get a new card with a lower rate or better terms than you have now? How can you do that without new hard inquiries? Well, I'm glad you had that thought, because there's actually a little known trick to cover this situation that legitimately almost no one knows about, and I'll uncover exactly how to get that new card without a hard inquiry before the end of this video. To understand the 7th way to boost your credit score for free, we first need to know the difference between revolving credit and installment loans. Revolving credit is a credit line that can be used continuously up to a certain limit as long as the borrower stays below that maximum and is in good overall standing. Credit cards fall into the revolving credit category. Installment loans, however, are loans that begin as a fixed amount and then have fixed payments that must be paid according to a schedule, where the original amount borrowed never changes. Automotive loans and mortgages are installment loans. Lenders want to see that you're responsible using credit. Therefore, somewhat ironically, using zero credit is not what's best for your credit score. Rather, you want to not only use a limited amount of credit, but to spread that limited usage across a mixture of both installment loans and revolving credit. This signals to the lender that you're responsible with all types of credit, and this is step 7. As an example, a no-fee credit card or two that you use lightly but pay off each month, combined with a small installment loan on a car, can boost your credit score in no time. Step 8 involves the most common misconception in credit scoring, and it has to do with the number of credit accounts that you have open. The situation goes like this. You decide to improve your credit score and start by closing unused credit accounts. The first credit card you ever opened has a low limit and a high interest rate, and therefore you go to close that one. But this is a mistake. While reducing an excessive number of credit accounts can be a good thing, maintaining a long credit history is a higher priority for the credit scoring algorithm, and therefore, not closing your oldest credit card is also the priority. But what if that old card is really bad? Here's a little known trick. To keep this long credit history, but also get out of a bad card, you can call the card issuer and ask for what's called a product change or a product conversion. When you request a product change, the issuer can transfer your existing credit history, including the length of the time the account has been open, to a new card with different and hopefully better terms, which is the best of both worlds. Step 9 is all about the ideal time to make your credit card payments for the purpose of maximizing your credit score. And the Step 9 strategy is so helpful, so little known, and so, well, free, that it's crazy that more of us don't use this strategy every single month. It warrants its own deep dive video shown here, and we'll finish our perfect 850 credit score journey there.